Welcome to Pankinen Financial Perspective with Ashton Pankinen from Pankinen Financial Group. Planning for your financial future means navigating challenges like market volatility, inflation, and retirement income. Pankinen Financial Perspective is here to help by addressing common financial concerns, sharing valuable strategies, and exploring ways you can work toward your financial goals. Now let's get started with Pankinen Financial Perspective.
Hello and welcome to Pankinen Financial Perspective. My name is Ashton Pankinen from Pankinen Financial Group. If you'd like more information about what you hear during our show today, give us a call at 952-873-2703 or visit us online at pankinenfinancial.com. That's PANKONIN financial.com. And while at my website, click on the radio page to check out past shows and subscribe to our program on Apple Podcast, Spotify, or Amazon Music. Also, while at my page, click the link at the top for our latest retirement guide and to sign up for our newsletter. Both life insurance and Roth IRAs have the potential to provide us with tax-free income during retirement. But the path to utilizing that tax-free income isn't without possible traps and roadblocks. During our show today, we're going to discuss the potential drawbacks of both life insurance and Roth IRAs and whether one, both, or neither would be a good fit for your financial strategy. But before we get into today's chat, let me introduce my co-host, Tony Shore, whose 1 in a million voice comes to us loud and clear every week.
Wow. Okay. I'll take that. I'll take that. That's awesome. Little over the top, maybe, but
I do get lots of compliments from people, Tony, on my co-host here. So
you've gotten compliments, huh?
I have, yeah.
but do they outweigh the what's that guy doing on a financial show? I don't understand. Yeah. But I am happy to be here as always. As always, Ashton, I think this is a good one. You know, I know a fair amount about life insurance and Roth IRAs, but you can always dig deeper. And I have a feeling you're going to have a few surprises in store for not only our listeners out there, but myself. I mean, this is your wheelhouse, and these are two great sources of tax-free income and retirement. So I know we're going to talk about the ins and outs, the good, the bad, and the great and the not so great. So before we get into that, though, it's funny. We were talking before the show about everything that's going on right now. And it's just, I love this transition. Fall is my favorite time of the year, maybe because football's back. We've got the state fair. We've got the Ren Fest for those who like that type of thing. And everything that's going on. You mentioned Valley Fair. Your wife took the kids, and I was giving you a hard time. It's like, oh, Ashton, you didn't make it. But I'll tell you what. I mean, I'm older than you are, but my big roller coaster ride days are behind me. Yeah. I loved it, but I lived for it as a kid. Like in my teenage years and 20s and even 30s, I loved amusement parks. I loved Valley Fair. I went there a lot. Growing up, my parents, I think once a year I got to go to Valley Fair, and living in Worthington.
That's a haul.
Yeah, that's a haul. I think we'd do Valley Fair one day and State Fair the next.
Okay.
And that was our yearly trip to the cities. Yeah, that was fun. Of course, the State Fair wasn't as crazy as it is now. I don't remember it ever being that full when I was there as a kid.
Yeah, I'm sure it gets bigger every year, and
it does. Every year they set new daily records. So
attendance,
over 200,000, 225,000 people in a day. I mean, that's
county fairs are plenty big for me. And my cheese curds and stuff. Great. You may not get Sweet Martha's cookies, but at least
true.
Fight it.
I still go now. Do you go to the state fair? Will you be going? Do you think this year?
We typically don't. We did talk. Our anniversary is coming up. We talked about going to that going that day possibly for our anniversary. But I don't make it a point to go every year. But we have been, once every couple of years or something like that.
Yeah, I go once every year. And I haven't went this year, but I thought, after we go, maybe on the show, we can talk about our favorite foods. Ooh. My favorite food at the state fair has been, there's a stand. It's on the back side of the food building. If you enter through that back door, there's an ice cream place on the right that has like some kind of frozen custard, and straight ahead and it's in the main food building on the backside. It's a burger place, burger and fries, but it's a wild rice burger.
Oh, okay.
And I'm not even a big wild rice fan, but it's the wild rice burger. It's thick and it's the juiciest, best tasting burger I've ever had. Every year I have to get that. That's why it keeps me coming back to the fair. That's how much I love it. And
Sounds
then
like you could find the place blindfolded.
Oh yeah, I could. And then the cheese curds in the same, main food building, that main big, huge cheese curd stand. Every year I have to have the cheese curds and the wild rice burger. Anything else is a bonus. Like if I try a new drink or food, but those two are, I go every year just so I can have those things and wander around and just watch people, right?
Yeah, people watching's great there all the time.
Yeah. I've run into some politicians there walking around. And I remember talking to Mark Rosen a couple of years ago, the sports guy, ran into him. So that's always fun. Yeah. Yeah. I like it, but it does get to be, the parking is it's so hard to park and get in there. And now the food is so expensive that, you got to limit it, but it's fun. And some people just, they live for it.
Oh yeah. Some will go every day.
Yeah. So that's fun. Well, hey, let's get into it because this is a big topic, life insurance and Roths. Where do you want to begin here?
Yeah, we'll frame today's conversation around an article, Life Insurance versus Roth IRA, which offers better retirement security. Planning for retirement isn't always straightforward, and let's be honest, it can be overwhelming at times, Tony. A lot of people spend years fine-tuning their investment mix with the right balance of stocks, bonds, cash. But one thing that often gets overlooked is where those assets are held from a tax standpoint. So they can be in different tax vehicles. And so which one's most beneficial? And taxes in retirement can end up eating up and costing more than even health insurance can. And so that's sometimes why we call them the silent budget killer. So withdrawals from certain accounts can trigger income or capital gains. And if not careful, they can push you into high enough income to raise your Medicare premiums in retirement as well. And so that's why it's important, Tony, to have some tax-free income stream in retirement. It can provide you with income you need to enjoy your ideal retirement. And a lot of times the Roth IRA is a popular option, but the strategy many people don't think about is life insurance, which can also offer tax-free income in retirement. Each has its pros and cons, and choosing the right one for you depends on your goals. And so, we agree that though it's not for everybody, it can be for a lot of people. It is one option. Yeah, that can be a place to start. And we talk about tools in the tool belt, Tony, or arrows in the quiver. And so again, it's one of those options for you.
Yeah, and I think this is good. I mean, choosing between life insurance and a Roth IRA or possibly utilizing both, that's a good topic or a topic that you really need to address with a financial services professional like yourself, because there's pros and cons, and it really depends on your individual situation. And you've seen all the different, you have access as an independent financial advisor. You're not beholden to just one company or one tool. You can look at all the options and say, for your goals and your needs and your time horizon, here's the best fit, right?
Yeah. And so again, because I am an independent advisor and I can offer insurance products and investment products, it's just another tool for me to use for those that it fits. Some financial professionals are only able to sell the insurance, and so maybe it isn't the most appropriate tool, but they're going to use that tool. And again, it's important to have an independent advisor that can offer both. But let's take a moment to break down the most popular tool for that tax-free income in retirement, and that's the Roth IRA. Or Roth 401k is an option as well a lot of time. But at its core, it's a retirement savings account that you fund with money you've already paid taxes on. And from there, you can invest those dollars. And there's big potential win there. When you retire, both the original contributions and the earnings come out completely tax-free. But there are some rules to keep in mind. In 2025, if you're under age 50, you can contribute $7,000 a year. And if you're 50 or older, you get to put $8,000 a year in. And that's per individual there. So if you got a married couple, we could do 16,000 if you're over 50. But not everyone qualifies. There are income limits. And so if you're single and earn more than 165,000 or married and filing jointly with income over 246,000, you may not be eligible to contribute directly to a Roth IRA. And another thing to remember is that 59 and a half retirement age, that's when you can start taking free withdrawals. And if you pull money out earlier than that, Tony, there might be a 10% penalty on it unless you qualify for one of the exceptions. And so again, there are rules we want to make sure we follow and guidelines for this. But that said, there is some flexibility, especially when it comes to accessing the money you pulled out. One of the nice things about Roth IRAs is you can always take out the amount you've contributed, the principal, penalty free. And so if you put in 7,000, it grows to 15,000. You can still access that original 7,000 without tax consequences because you've already paid taxes on those dollars.
Wow. Well, and you've noted this on previous shows that a Roth IRA isn't going to be the right move for everyone. And I just want to stress to our listeners, it's so important to go over these things with a trusted financial professional before you make any final decisions about a Roth IRA. I know, you've mentioned before to me and on the show, Ashton, that how valuable a Roth can be and how great they are. There are so many positives when it comes to Roth IRAs, and so many people can utilize them effectively for that tax-free bucket of income in retirement. You want tax-free income in retirement to reduce that burden. A lot of people think, why would I be worried about taxes in retirement? I'm no longer working. But traditional accounts like your 401ks and your traditional IRAs, it's all taxable. It's been growing and growing and growing, tax deferred. You don't have to pay taxes on the money when you put it in. You get that off that year. But the money, when you take it out in retirement, it's fully taxable. And
Correct.
That can bump people up into a higher tax bracket and cause all sorts of issues. So Roths are great, but may not be the right move for everyone. So go over your strategy with a professional.
Yeah, exactly. Yeah, it's important to make sure you reach out to a professional. And if you have questions on what is the right fit for you, you can reach out to our office. Give us a call. We'd be happy to do a consultation, either over the phone or in person. You can give us a call at 952-873-2703. Again, that's 952-873-2703. Visit our website, pankoninfinancial.com. That's PANKONIN financial.com. Again, everybody's situation is different. And so it's important to reach out to a professional to see what's appropriate for you.
Okay. What do you want to talk about next? We've talked about Roths. How about life insurance?
Yeah, let's talk about life insurance, retirement income strategy that often flies under the radar. And again, unless you're an insurance only agent, again, it's one tool that fits for some, but not for all. Most people look at life insurance as a way to support loved ones after they're gone. And that is true. It's a powerful legacy tool, but it can also play a surprising role during your retirement. For example, some policies let you tap into benefits early if you're dealing with chronic illness or long-term care. Others are used specifically to create an inheritance, which may free you up to spend your other money, other retirement assets with less worry. Knowing that, hey, the kids are still going to get something from this life insurance benefit. And then another thing that gets even more interesting is if you own a permanent life insurance policy with a cash value, it can potentially become a source of tax advantaged income in retirement. And not all policies work the same, Tony. So it's important to know what you have and what you're considering. One option we sometimes use is variable universal life. It lets you invest in things like stocks and bonds, just like a Roth IRA. Of course, that comes with market risk, so it's not for everyone. Sometimes we look at whole life policies or index universal life policies. The index universal life, they have some downside protection. They have indexes that can potentially give you some upside there as well. But either way, the potential tax benefits are appealing. Depending on how you access the funds, that cash value can grow tax deferred or even come out tax free in retirement.
Yeah, and I like the sound of that, tax free, and you are too during retirement, listeners. I'll tell you that.
Yeah, tax free is great thing to hear.
It is, and I mean, you've been talking about how life insurance and Roth IRAs can help people, create reliable retirement income, and how at the same time, both products may have drawbacks depending on your situation. It all depends on your broader financial strategy, your long-term goals. Everybody has different goals for retirement and a different time horizon. And timing is such a big part of all of this, how it's going to fit in with your plans for retirement. But if you can make it fit, that's great. If it doesn't fit, you need a professional to say, hey, no, this isn't right for you. So many people come to you, and I bet when they come to you, a lot of them are underinsured, and some of them are even overinsured, right? And you point that out saying, hey, you're overinsured in this area where you don't even really need it. And you're kind of and it's not really helping you in the long run or will help you in retirement. But over here, you're going to need something to ensure your retirement savings, things like that. But I think it's been a great show. What's next?
Yeah. And so you mentioned, overinsured and making sure we got something in place there. But so it can actually be used to generate retirement income. And oftentimes, it's also a just in case strategy.
Sure.
And so it's not always that just in case strategy. I do a lot of that. And we usually use a non-permanent product like term for that. And so you mentioned underinsured. So I've got a lot of younger individuals that come into my office, got a young family to protect, maybe have a mortgage on their house still. And so it's important to evaluate that. And that's more that term product for what if we die, or just in case, what if we die before we're supposed to? And so it's important to make sure you got enough coverage there to help the loved ones there. But again, we're talking more retirement income. And so that's going to be a permanent type product. And so if you're using life insurance this way, a lot of times what we end up doing is taking loans against the cash value of that permanent life insurance policy. Those loans don't usually need to be repaid during the lifetime. Instead, the outstanding balance is deducted from the death benefit when the policy pays out. And so whatever's left after the loan settled goes to your heirs or your beneficiaries. And so that might sound pretty straightforward, but there are a few important pieces to understand before using this strategy. First, this approach isn't for everyone. Again, it's a tool we use for the individuals when a lot of times we fill that Roth IRA bucket first, maybe even that 401k bucket. And then we kind of evaluate from there. So if you're in a low tax bracket now and expect to stay there in retirement, it might not be the most efficient route. And to make this strategy really work, you've got to start it early because it takes time for that cash value to grow. And even after 10 years, many people find the cash value hasn't grown much. And because they basically got what they paid in premiums. And that can feel frustrating, and especially when you factor in the fees. And so, again, it's not for everybody, but it's an important tool to know about.
Yeah, and it depends on, again, your time horizon, how much time you have to let it grow. It can work really well depending on your situation, but you do need to know the ins and outs. So what are some strategy scenarios that our listeners should discuss with their financial services professionals regarding this?
Yeah, I mean, one of the things you want to do is you want to make sure you actively manage that death benefit. It's a step a lot of people overlook. You want that policy to be lean and efficient. And the more death benefit you have, the more cost there is to the insurance. Sure. And therefore the cash value doesn't build as much. And so again, our goal in these is to build that cash value. And then at some point take a tax-free loan against them. And then, another part is the investments inside of there. So there's the investments in the insurance. And so again, depending on your risk, we might look at a variable universal life, or if you aren't willing to take that risk, an index universal life that's capped downside protection, or has downside protection, but it's also capped on your returns depending on the indexes.
Sure.
Another thing, we also want to be very careful. Our old friend, the IRS, we don't want to violate their rules.
Right.
They govern how much premium, cash value, and death benefits, how they can be balanced, the ratio on those. And so if you cross certain thresholds, your policy could be reclassified as a modified endowment contract, or a MEC in our industry is what we call it. And that means their gains could lose that tax advantage. And so it's always something, if our goal is to use this for tax-free income, that we want to make sure it doesn't MEC or create a modified endowment contract.
Right. And that right there is the reason somebody needs to work with somebody who's looking at their big picture, their overall financial plan, to make sure that they don't get into that situation, that they have the right balance. And that's what you do for your clients. So again, you've got to work with someone who's well-versed in both options, all the options, to determine if and how a Roth IRA or life insurance policy can fit into your retirement plan. You have to do your homework. Work with somebody who knows how to build that overall plan.
Yeah. Yep. For sure. And again, Tony, any questions on it, they can reach out to my office, 952-873-2703. Visit us online, pankoninfinancial.com, PANKONIN financial.com, and we can walk you through what tools are going to be the best fit for your plan, customize it to you. We are, again, a fee-based advisory firm. And so when you do better, we do better. And so I just want to make sure it's a good fit for all these individuals.
Yeah, I think that's great. So what's next?
Yeah. So again, when we're looking into Roth IRA or life insurance, see if it's a good fit. We want to make sure that your goal for tax-free retirement income, it's going to be accessible for you. And so again, a lot of times we want to have buckets. And so one of the buckets is going to be that tax-free bucket or pools of money. And then we want to have tax deferred or taxable in retirement money. And the reason we want both, you might say, well, Ashton, why don't we want all tax-free? Well, a lot of times in the earlier tax brackets, or the lower income, you get a little bit of a tax break inside of there. And so, you don't want to have all tax-free when you could have gotten some out at 10%, or even a lot of times 0 to, I can't remember what the bracket is, but maybe the first 10,000 is actually tax-free from the federal level. And so we want to make sure we take advantage of both of those. And that's why it's important to have a pool of both. Life insurance can also be a powerful retirement income strategy for those high income earners who've already maxed out their Roth or aren't eligible because of income limits. And then another potential perk of using life insurance is you don't have to wait till 59 and a half to access those funds. But the trade-off is that life insurance strategies can be a little more complex and expensive than like your Roth IRA. And so a lot of times we don't see it as an either or. We want to look and see which one's going to be the best fit, and they can complement each other as well. And again, it just depends on your overall financial picture, your income, and what kind of flexibility you want in your retirement.
Yeah. Yeah. And I think that's, it's so important, obviously. So let's say, again, you need to know the rules, work with a financial professional, make sure you're getting the most out of every dollar you save. If a new client comes into you and wants to talk about 401ks, Roth IRAs, or just regular IRAs and life insurance, what's likely to come up during that first conversation?
Yeah, again, we want to talk about the goals. What is your ideal retirement look like? We want to create that solid strategy. Again, a lot of times we end up maxing out that Roth IRA and then possibly the 401k. And then if that's something where you have excess funds, then we look at the life insurance there. And so we want to make sure we can get a smart way to grow your nest egg and potentially lower your tax bill along the way. And again, it's important to know that some of these higher income earners, there are limits on how much you can deduct from an account, or if you can contribute to the account in retirement as well. Or I'm sorry, as you're building your retirement.
Yeah.
As well.
Yeah, exactly. So, yeah, what about this? We've been talking about saving in a 401k and an IRA in the same year. Where do you want to head next?
Yeah, again, let's just touch on contribution limits. I know we've talked about them before, but it's important to remind us that, hey, let's take full advantage of these if we can, if you have it in your budget. And so if you're putting into a 401k in 2025, you can defer up to $23,500. If you're 50 or older, you can actually, that jumps up to $31,000 with catch-up contributions. And new this year, those between 60 and 63, there's a little more boost there, a little extra boost. You can put $34,750 into your 401k plan. And that's a big opportunity to save, especially if your employer also offers that match, because now that's free money on top of what you're contributing as well. And then IRAs, again, work a little differently. The limit there is $7,000 for anybody under 50. And then if you're 50 and older, it's $8,000. And again, these limits are independent, and meaning you can contribute to your 401k and IRA. That's a very common question I get is, oh, I can do a Roth IRA. I already contribute to a 401k at work. And again, they are separate pools of money with separate income limits as well. And so you may be able to defer $38,000 or even more for that retirement, and whether that's tax deferred or tax free in retirement. And so again, that's where someone like myself comes in to help you make sure you qualify and whether your income affects your ability to deduct IRA contributions. If we're looking at traditional IRA contributions, if you earn more than $79,000 for individuals or $126,000 for couples, you may not be able to contribute to the traditional 401k, but you may be eligible for the Roth. Depends on if you have something available for you at work or not.
Great show today, but we're almost out of time. And Ashton, before we go, I want to make sure that you give our listeners another opportunity with the information to reach out to you and set up that no charge, no obligation consultation.
Yeah, again, give us a call. We can give you a complimentary review of what you got going on. Our office number is the best way, 952-873-2703. Again, that's 952-873-2703, or visit us online at PankinonFinancial.com. That's PANKONIN financial.com.
All right. Well, Ashton, great show today. A lot of great content for our listeners. And listeners, that does it for today's episode of the Pankinon Financial Perspective with our host, Ashton Pankin.
Thank you for joining us for Pankinon Financial Perspective. Don't head into retirement without a plan for both your finances and your health. For more information, contact Ashton Pankinon at Pankinon Financial Group at 952-873-2703 or visit PankinonFinancialGroup.com. Join us again soon for another episode of Pankinon Financial Perspective. Advisory services are offered by Ashton Pankinon LLC DBA Pankinon Financial Group, an investment advisor in the state of Minnesota.
All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Social Security Administration, the Federal Medicare Program, or any other government agency. Calling this number will direct you to a licensed sales agent.